You're listening to The Real Well Show with Kathy Fedke, the real estate investor's resource.
With home prices and interest rates up dramatically these past 2 years, does it still make sense to acquire real estate today? In some cases, the cash flow is so low and sometimes non-existent. I'm Kathy Fedke, and welcome to The Real Well Show. A lot of people think we've reached a peak in home prices and they're waiting for prices to drop. Our guest today thinks waiting is a big mistake and that the opposite will happen. The prices will actually continue to rise. Jimmy Vreeland is not an economist. He's an investor who has owned over 100 rental homes over the past decade. Jimmy is a 2003 graduate from the United States Military Academy at West Point and Army Black Knight football alumni. He served in Iraq and Afghanistan and managed to start building his real estate portfolio while in the military. And he's here today to tell us why he's still buying. So, Jimmy, welcome to The Real Well Show.
Hey, how's it going?
It's going well. I'm so excited to have you here because I think you can give me and our audience some insight on what people are doing today with interest rates rising and home prices rising. And, does it still make sense to acquire single family homes or 1 to 4 units at this time? What would you say to that?
I have always felt this way about real estate. You don't wait to time the market. You don't wait to buy real estate. You buy real estate and then you wait.
Yep. I go by that motto as well. However, in some cases, let's take you, for example, you're in the Midwest. It's not typically a growth market. So it's always been a place where people go to get cash flow. But that's not really on the table right now, right? I mean, or is it? Are you still finding properties that cash flow?
Yeah, I mean, it's still on the table. I wouldn't advise anyone to buy houses that they have to feed cash into every month. But, the 1% rule, no. If your buying criteria demands that you buy 1% houses where the purchase price is 100 times rent, you're just going to be waiting.
Yeah, and that's why I'm rewriting my book.
Oh, really?
Yeah, my book, Retire Rich with Rentals. I put that in there, that model of, try to have your rents come in at the 1% rule.
Yeah.
Yeah, and that was always what we were doing. If you bought $100,000 house, you hope the rents come in at 1,000.
Yeah,
and but that really never even made sense then because it all, what about taxes and insurance? I mean, every place is different. So you're just talking about gross rents, but that was kind of a general rule back then. That was 15 years ago, even 7 years ago, 5 years ago, that might have made sense. But again, I'm rewriting the book because people come to us and say, I can't find anything at the 1% rules. I'm not going to buy anything at all.
Right.
So in a cash flow market like you're in, what do you do when you're not, when cash flows are changing?
Well, here's how I've always hated about the turnkey market and selling in the turnkey market is I have to sell based off cash flow day one. And this is a long-term asset with, for most buyers who aren't buying cash, they have fixed interest rates for 30 years. Is this a phenomenal cash flowing investment? It is, but the cash flow hits because rents rise and your cost of capital stays the same for 30 years. And so what I saw happening is a bunch of people not buying who, if they have bought 5 years ago, they would have the cash flow they wanted. So a bunch of people are getting upset because the Proforma doesn't say cash flow today when they're missing the boat on all the cash flow they're going to get for 30 years. And so for me, the interest rate rise has been kind of good because the pressure's off for me because I always felt this pressure that I got to show so much cash flow in year one, which is if you bought rentals, if you've owned them long enough, that's the hardest year. And so now I'm straight up lowering the expectation of year one cash flow, but being like, look what you get over the course of 10 years with especially with inflation now. You're almost guaranteeing appreciation. So, and single family rentals between appreciation, cash flow, the ability to use leverage and taxes, the way I do the math, it's a 30% IRR year after year. And I could go deeper into those numbers if you want me to.
Let's go deeper into those numbers because one of the things you said that kind of caught my attention is the first year is the hardest. What do you mean by that?
The first year is the hardest. It's a new tenant. It's like any other, like a car, like you buy a new car off the lot, there's always going to be something that rattles or ranks. You got to break it in a little bit, right? Same thing with a freshly rehabbed house. Like you got to break it in. Like how many houses have you had where like it passes all municipal inspections, it passes all third-party inspection, tenant moves in and immediately they have a maintenance expense, right? And the buyer could be like, how could you not see this in the initial scope? And it's like, because like this is a house with human beings and that these things happen.
And it's old.
And it's 60 years old.
Yeah.
And like my contractor's not living there and taking a shower in there 3 weeks in a row.
Yeah, that's a really good point. I mean, of course, I've had issues 5 years later, right? I mean, you houses need repair. That's why you've got to calculate that in your pro forma. How
Well,
much?
I mean, I would argue that's why you have to not care. Let me do some math that I'm running.
Let's do some math. You know how bad people are at math. So let's just do some math. But hey, people are driving, listening to this. They're multitasking. So keep it simple.
I listen to your podcast while I'm working out. So I hope you're right now. If you're listening to this, you're in a deep squat. Don't squat during this because this number could alarm you.
Oh, boy.
I don't want you to fall over and tear an ACL.
Good.
But
good to let them know.
Since 1950, the median home price of any house in the United States has doubled every 20 years, to include the great crash of 2008. Between 2000 and 2020, home prices still doubled. Like, you know, everybody has scars from 2008, but at the end of the day, it was a blip. Everybody who had stayed in the game and was liquid enough was fine by 2011. Yeah. And then their investment still doubled. So here's the quick math. I know it's not crazy exciting like buying a tech stock, but consistent appreciation over the long term is very exciting, even if it's 5% a year. So let's say you have a $100,000 house. What's your actual cash investment?
20.
Okay. And let's say it appreciates $5,000. What's your rate of return?
Yeah. It's
25%.
25. It's going to be more than 20,000, right? Because you got closing costs. But let's.
But no. I argue with buyers on this all the time.
Oh, you got me. All right. Tell me what am I doing wrong with my math?
Your closing costs you need to amortize over the course of 30 years because that's a one-time expense that you pay for the life of the investment.
So you just put it in the loan.
Yeah, and you put it accounting-wise, you amortize that expense over the course of 30. That's so $2,500 in closing costs is a ticket to the game, and you spend 30 years in that game.
Mm-hmm. Okay.
So even in my pro forma, I put the closing costs because people are sticklers, but like, don't not do a deal because of closing costs.
Yeah, that's fair. Okay, but so let's say you still got to pay them, so you're putting $23,000 into that $100,000 property, and if you're making $5,000 at a 5% appreciation rate in a Midwestern area, that's still a pretty darn good return. You know, try to find it.
25% return.
Yeah. Try to find that anywhere else.
That's the power of leverage.
Yeah. And it's not crypto that will just disappear overnight.
Crypto is great. Like, you know, there's a lot of cool strategies I'm seeing coming out, leveraging crypto and real estate together. But the thing that stinks about crypto is what do you have to do in order to get a return?
Hope.
No, you have to sell it.
Oh, you got to sell it. Yeah.
And then you got to play the game. What I love about real estate is you're getting these returns, you're getting this cash flow, and you don't have to sell the asset. Then you don't have to do the due diligence to buy another asset.
Yeah. Yeah. Especially over time, you can refi and tap into that equity gain, let's say after 10 years. If it kept appreciating at that rate after 10 years, there's a bucket of money there that you can tap into, refi, and go buy some more.
And you have 70 years of data saying, hey, a 5%, this is before the government like really heated up the printing press by, printing a third of the money supply in the last 2 years. That's with just regular government irresponsibility.
Yeah, and that's the interesting thing is you've got a lot of people on YouTube with their fancy YouTube channels and editors and fancy lighting and all that, predicting a crash, a real estate crash coming. I constantly hear people in the notes of my shows saying, "How can you promote real estate when the market's about to crash and so forth?" And yet you're saying that we're looking at inflation and appreciation over the coming years. So how do you say that we're going to see prices continue to rise when you've got these YouTube experts saying that we got a crash coming?
Are these YouTube experts actually have skin in the game, like own assets?
I don't know, but that's
I could go on YouTube and convince you the sky's purple.
I'm really just kidding about that. But if you go anywhere, if you just sit down in the park and someone sits down next to you, they're going to talk about this wild and crazy housing market. And they're going to talk about how they can't wait for prices to go down so they can finally buy real estate. What would you say to them?
No way. Because of the hedge funds. Like the hedge funds come into the game, that wasn't happening in 08. So let's say there's a 10% decrease in price. What is every hedge fund on earth going to do?
Mm-hmm.
Buy everything.
They're already buying everything as much as they can.
At the prices we are now. Like I to get a house from a hedge fund, and we sell houses to hedge funds, but like when we compete with hedge funds, it's like, you got to these guys are creating if you're a turnkey buyer, you could be frustrated by the hedge funds that they're driving up prices, but I would say they're your ally. They're providing the floor for your investment.
Say more.
Just like I said, let's say there's a 5% decrease in price. If there's a 5% decrease in price, do you know what I'm going to personally do?
Buy
everything. Do you know what BlackRock's going to do?
Yeah.
Buy everything. If there's a 10% decrease, do you know what I'm going to do?
Probably buy a few more.
You know what BlackRock's going to do? They're going to buy 100 times what I'm going to buy. So there's a floor to this market. There's no way. Now, what I do think is going to happen is there's going to be a price leveling.
Mm-hmm.
Like since the interest rate rise, here's my conclusion. Are you ready for it?
I am ready, but I don't know if we finished the math. Do we finish?
We'll get back to the math. We'll get back to the math.
All right.
We're going to go from crazy stupid to just stupid.
Okay. Let's go to stupid and then go back to crazy stupid for a minute.
Yeah. So I think we're going to go back to like what it looked like in 2019, as far as like being able to get houses, being able to do certain things.
Okay.
But like people on YouTube may be saying like 2008, and I never speculate, I never predict, but I just, I don't necessarily see that being the first thing that happens.
Do you mean when you say things will go back to 2019, are you talking about sales volume? You're talking about pricing?
Yes.
Sales volume.
I'm talking about inventory. I'm talking about sales volume. I'm talking about the rate of price appreciation.
Mm-hmm. Yeah. So often people just read the headlines, and a big one that confuses people is the Case-Shiller index, because that's old data. That's 3-month-old data. So it'll be June, and you're talking about, what is that? April? No, March.
Yeah.
March. I mean, interest rates hadn't even gone up in March, and yet in June you'll have a headline about home prices, and people are just super confused. And they're just confused when they see sales have dropped, and they're thinking prices have dropped, but no, it's just sales because there's not enough inventory. So you've really got to dive in and understand what you're looking at. Read the article, not just the headline. And even the article is probably not correct. There's a lot of people trying to predict things that don't have an economic background, or just don't study it, don't understand it, aren't boots on the street, don't see what's going on.
Well,
so
I would never try to. That's not why you invest in real estate. You're investing for the long term. Like I bought that houses in 2007, 2008, and as long as I was liquid enough to make the payments, they all turned out to be great investments.
That's great. Yeah, that's really comforting for people who didn't go through that and are scared because they don't want to go through that.
But yeah, then they give up all the benefits of it. Like you don't wait to buy real estate. You buy real estate and wait.
Yeah, but it's got to be good real estate, because you don't want to sit on a property that's not renting for the 10, 20, 30 years that you're holding it. So
no, it's got to be managed well. It's got to be I would never buy D class. it's got to be in good working class neighborhoods.
Yeah, I'm with you there, especially because we want to have it for the long term. So it needs to be a good, solid quality property.
Yeah.
Let's go back to the math. You were going to blow my mind. So let's do it.
We're already at 25% cash and cash return on just appreciation. So what I do think you can expect now, instead of 10% appreciation, I think 7 is very doable for most turnkey providers in the Midwest.
Mm-hmm.
So we're at 32% right there. And then if you're in a 35% tax bracket, throw on another 6% for tax savings year after year. And then you also have the tenant paying down your mortgage, which there's another 5% right there. I mean, that's real money, especially when you hold it for 10 years.
Yeah, I hadn't really reverse analyzed it that way in terms of percentages, but what you just said, it can happen and work in any single market, unless it's not an appreciating market. But then you need to just take the 7% out of that. But then all the other things, all the other benefits are still there. However,
with the government printing money the way it is, like it's going to appreciate. It may not give you any more buying power, but it's going to appreciate, because
you're gonna stay ahead of the declining value of the dollar by owning hard assets. Yeah,
and the rents are going to rise too. And if you have 30-year fixed mortgages on all these, your mortgage payment stays the same. Sure, some of your other expenses go up, but your rents keep rising. And so, like year 10, the cash flow on it is silly. And then that's what I experienced through the houses I bought in 2007, 2008, is the rents went up.
Yeah, so it's interesting. I'm really glad you're on today, because we are always looking at growth markets like the Southeast, Florida, Texas, Georgia, the Carolinas. These are areas where there's massive growth, but the Midwest isn't really experiencing that kind of growth. So we've always said, go to the Midwest for cash flow, go to the Southeast for appreciation. So I wanted to talk to you and say, well, what do you do when you're in a cash flow market and now prices are up and interest rates are up and the cash flow is not really there, but you're not in an appreciating market. You're in a cash flow market, but you don't have cash flow. So I think you just answered it, but again, how would you answer that?
I'd say, the great thing about the Midwest is, like, we're going to go up, but we're not going to go up like Florida. But we also are not going to go down. Like the way I've always sold St. Louis is, I love it because it's exceptionally mediocre. The highs aren't that high and the lows aren't that low. But what you can bet on is the house will appreciate to keep up with inflation. The rents will appreciate to keep up with inflation. If you buy the house with 30-year fixed leverage, it's the best investment on earth because you have basically no risk. And the taxes will stay somewhat not ridiculous. And you got one tenant paying down your mortgage.
Yeah. Yeah, I mean, my recommendation has always been to people, many of our listeners, many of our members at Real Wealth are from high-priced markets like California and New York. And if they can just sell one property that has appreciated enormously, if they bought something 10 years ago for $300,000 or $400,000, it's worth $1 million today easily. So they can take that and go to a market and buy 5 properties from that one. And now they're more diversified. If they have a vacancy, they've got 4 other properties that are rented. If something happens to one property, they've got the 4 others. So it's a really solid way to diversify and increase your cash flow.
Yeah. And like when I say it's like year 1 cash flow it's a few points down from where it used to be. It's like over the course of 10 years, who cares? And the other thing is, if you're buying now, you're buying the price leveling. Cause like I hate predicting, but I don't see a scenario where prices drop massively, maybe in some of the overpriced markets on the coast, but who cares what the interest rate is right now? We all know the interest rate will go below 6 at one point, right?
Yeah.
So you just refi out at that point.
Exactly. What interest rate were you paying when you first started?
6.5.
Yeah.
You want to hear a funny story?
Yeah.
I started buying when I was in the military in 2006. And like I would deploy, I would not spend any money because I was deployed and not pay any taxes because I was deployed. I'd send my money back to my mom and brother who had just read Rich Dad Poor Dad. And I distinctly remember my mother saying, interest rates are at 6%. It'll never be this good. We have to buy everything.
Oh, it's amazing. I remember my dad was so excited when he got to refi out of the double digits and get a 9% interest rate. He was beyond thrilled. And then a few years later, he got to refi again because it went down to 7.5%. That's when Rich and I started. And we were so excited because we knew he'd been paying double digit interest rates for so long. And, of course, every year after. I'm with you. I think rates are going to eventually go back down because the Fed is trying to slow down the economy. And in doing so.
Thank God.
Yeah, thank goodness. It's so red hot. 2 jobs for every 1 American. So it's a new game, but I really appreciate you saying how you got into real estate. So you were in the military. When did you start investing? It was because your family had read Rich Dad Poor Dad?
No, they read it and then they sent it over to me. So I was like in the middle of Iraq reading it. I'm like, oh my God, this is awesome. We got to do this.
And then what?
Then we bought. I would every year. And this is the other thing. What I tell people is like, buy 2 houses a year for 10 years and you're set. So I started buying in 2006. By 2016, I quit my job and was able to go into real estate full time.
Nice.
Because when you have appreciation, cash flow, leverage, and taxes on your side, it's almost inevitable that, and all you really need is 2 houses a year for 10 years.
Well, that's a really great story because if you started in 2006, you bought at the peak, then you went through one of the greatest housing recessions. Then you went through one of the biggest rebounds, although, of course, the COVID rebound was even bigger. And you were still in that time period of buying at the peak, going through a recession, you still, after 10 years, were able to retire. That's incredible.
Well, not retire, but
be full-time real estate. Yeah.
Yeah. It's just, I love real estate because you win in 4 ways. Like the stock market is so boring to me. You buy low and sell high. Like that's like football before they invented the forward pass. You would just have 11 guys line up next to each other and bang their heads together and only run the football. Like it's so boring. So
I imagine people aren't feeling really bored today. It's been quite a ride.
I haven't had any money in the stock market in like, what year is it? For like 15 years. So I have no idea. The other great thing about real estate is the peace of mind. Like I don't watch that stuff.
Yeah.
What happened today?
Well, no, Rich and I don't generally invest in the stock market, but in 2020 when it tanked, we're like, okay, this might be a good time. Yeah. So we did, but no, it's just been all over the board for the last month, which is terrifying for people to watch their retirement savings change by as much as 30% in a month.
Well, it's not
terrifying.
It's not retirement savings. It's retirement speculating.
You're
not saving. Like saving means you like put the money away and you keep it liquid.
Mm-hmm.
You're buying low and you're selling high. That the technical definition of that is speculation.
Yeah, I mean, you're an example. You bought at the peak in 2006, and you weren't buying or selling. It was an asset that cash flows.
The technical definition of investing is departing with capital for a certain amount of time to get a rate of return, generally in rents, dividends, or interest. And the definition of investing has nothing to do about the value of the underlying asset. Of course, you'd like it to go up.
Yeah.
But like, as everybody saw in the crash, rents went up. So who cares if you're underwater on your rental, if you had 30-year fixed mortgage, if the tenant was paying the rent?
Yeah, that's one thing I've really noticed with so many people in multifamily. Not that I have anything against multifamily, but I've noticed that it's really been, for a lot of people, more of a speculative game of flipping apartments, as opposed to, are you really holding this investment for the cash flow? I don't know if you
because you get paid on the waterfall.
Yeah.
On every, where I came up with this 30% IRR is like I learned from my multifamily buddies. They sell on IRR. They don't sell on year 1 cash flow.
You got to look at the whole thing. I've been wanting to put together a Proforma, and if you or anyone listening can do this for me, where you can put your entire portfolio into a spreadsheet and look at where it will be after 10 years with the loan pay down, with the tax benefits, with the appreciation, and see. I had sort of a rudimentary one many years ago, and I would show people, if you buy, like you said, 2 properties a year, but I was saying up to 10. If you can just acquire 10 properties,
Yeah.
look where you'll be in 10 years. And it was mind-boggling. But I haven't come up with that. So again, if you have that, or if anyone listening, I want that spreadsheet so people can really see how it grows over time. I think a lot of people have woulda, shouldas these days, but I think the general woulda, shoulda is I should have bought more. I should have bought more.
And you asked about interest rate on my rentals. Like I bought 150 of my personal rentals on private money at 10%.
Wow.
And like I have a few $1 million of equity now. And then I just refied into commercial loans. And before the interest rates raised, I was going to refi into 30-year non-QM loans. But then I missed the boat on that.
I know, I did too. Sometimes you get so busy, you forget about your own portfolio. Anyway. Yeah. Oh, well, Jimmy, it's been really a pleasure to have you here on the Real Wealth Show. And any last tips? I mean, you've given so many, but any last tips you'd give to people who are waiting for prices to go down before they buy?
Here's what I'll leave everybody with. There's one thing you have to do to be known as a genius real estate investor. Do you know what it is?
Do it.
Do it
Take
for
action.
10 years.
Do it for 10 years.
I've never met anybody who's owned real estate for over 10 years who doesn't look like a genius.
Who wish they hadn't. Yeah. That's right.
Or just doesn't look like a genius. Like I made every mistake. I forgot about houses I own. But since I've owned them for 10 years, I look like a genius.
Very good. I appreciate it. Well, I think there's a lot of listeners who are looking forward to the genius level in 10 years. So thank you.
2 a year for 10 years. I mean, do you think prices are going down? I think on each coast, I think they're going to level.
No, I don't even think on the coast. I mean, it depends, but we're just in the outskirts of LA, and I helped my daughter buy a ridiculously expensive house. She did it by herself. I just helped her find it. But she had money in another house. But anyway, she paid way too much, and it was scary for everyone. It was like 1.1 million. She's only 29 years old, but that's what the prices are. And it was a really scary time. But I said the same thing. Look, the payment is the same as you would pay in rent. So you're going to live here for what, 5 years? So think about 5 years from now. Rents are going to be higher. And anyway, in just a month, the house went up $100,000, and rents. The worst part is that rents around are $1,000 or $2,000 more a month than her locked-in payment. So it's very, very sad for people who are renting. That was my main concern, is like, oh my gosh, if you're renting your primary residence, you have no security. You do not know how bad rents are going to get, and if there's even going to be any.
Interest is all tax deductible, right?
Or even if there's going to be anything for you to rent. So that's the concern. That's why I'm constantly telling people we have a very, very strange situation where we've got a massive demographic buying and just a dearth of properties. They're just not there. So, I was like, whatever it takes, honey, buy this house. Also, I had I had my personal motives because she's 30 minutes away and I wanted her near me and the grandbaby. But I also just didn't want her necessarily moving home, and wanted to make sure she had a place to live. Like it is concerning. So that's from a caring perspective. Whatever it takes, people just get into ownership sooner than later.
And the other thing I'm going to leave you with, or the audience with, is like the asset never fails. It's the borrower's liquidity that fails.
Yes. So
you got to have, the other thing I'm saying, sure, buy more houses, but keep more reserve around.
Absolutely. I hear some people say they're going to put 30% down for safety. I'm like, no,
don't put more money down. Keep it liquid. Reserve.
Keep it liquid. That's how you find safety. People think they're going to put more money down and be safer. No. You need liquid reserves. Put 20% down, put the other 10% you were going to put down in the savings account so that you're prepared if anything goes wrong. 100%.
Was that your experience? It's like the borrowers in 2008, the people who failed in 2008 didn't have the reserve to cover the mortgage payments when things got tight.
That's it. That's 100%.
There's nothing wrong with the asset. The asset doubled in value.
Yeah. And stayed rented for the most part. Many of those homes stayed rented. Yeah. All right, Jimmy. Well, this has been wonderful. I really appreciate the reminder, because I do ask myself sometimes, I am looking at that first year Proforma going, wow. But you're absolutely right that 5 years from now, maybe even a year from now, definitely 10 years from now, and for sure 20 years from now, you'll be looking back going, I cared about $2,500 closing costs.
It's like having a kid and looking at their numbers their first year of life. Like, nobody's concerned about that.
Yeah, absolutely. I mean, literally, I look at the deals I passed in Austin where I could have bought houses for nothing, but it was like, oh, it's just not good enough cash flow. I can get better cash flow elsewhere. It is a $50 difference. Come on. Those prices have tripled, if not quadrupled since then. All right. Well, thank you so much for joining me here on The Real Wealth Show. And now that I know that you work out to The Real Wealth Show, I'll make sure we have some good music or something in the background. I don't know.
Nice. The pump-up music.
All right. Good. Well, thank you. Good to see you. I hope to see you around soon. And thank you for joining me here on The Real Wealth Show. If you'd like to know how to contact Jimmy and any of the other 15 property providers in our network, just go to realwealthshow.com. Once you're there, you can talk to one of our very experienced investment counselors or get access to market data on some of the areas where we really think there's a great chance of appreciation and cash flow on the way. It's free to join. Just go to realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.